What's up, everyone? We're going to talk about dematerialization, and subtitle is Aligning with the Enemy, because that's exactly what has happened. Let's go ahead and take a look. Now, this is an article or a white paper from the industry in 2012, a long time ago. It's called Strengthening the U.S. Financial Markets, a proposal to fully dematerialize physical securities, eliminating the costs and risk they incur. The cost and risks to the DTCC, that is. So, what is dematerialization? Well, first let's look at the background surrounding this topic. So, if we look at this paper, they give a little bit of background, and it starts with the paperwork crisis. The push to eliminate physical securities originated in the paperwork crisis of the late 1960s. So, again, this is a crisis that has been going on in the eyes of the DTCC since the late 1960s. When trading volumes surged and the back offices of banks and brokerages were inundated with stock certificates and the associated paperwork, hundreds of messengers scurried through Wall Street lugging bags of checks and securities that had to be exchanged for each trade. The crisis became so severe that the exchanges closed every Wednesday, shortened trading hours on other days, and extended settlement by a day to T plus 5, trade day plus 5. To tackle the mounting backlog, the NYSE and Central Certificate Service immobilized stock certificates by maintaining them in a central location, registered in a nominee name. Ownership or transfer of stock was recorded using a bookkeeping entry. However, for various reasons, including the fact that program was voluntary and individual, state laws require brokers to give investors physical certificates. This initiative met with limited success. So what are they saying? Since people had an option, we didn't really have much success with this. In 1970, several leading banks and exchanges formed the Banking and Securities Industry Committee, or BASIC, to overcome these challenges. Their efforts culminated in 1973 with the creation of DTCC's depository as the central location for certificate immobilization. You know, that place, the DTCC. So, immobilized through fast. Aware that merely immobilizing certificates in its vault wouldn't provide the economies of scale required to handle the rapidly expanding U.S. markets, DTCC's depository soon launched the FAST Automated Securities Transfer Program. FAST minimizes certificate movements and streamlines transfer processing by recording the securities in book entry form on the books and records of the issuer's transfer agent. This reduces the risk associated with lost securities and eliminates the cost of insuring, handling, and shipping physical certificates. So there you go. You're giving up your insurance, you're giving up your ownership rights, and you're reducing the DTCC's risk. With FAST, transfer agents maintain a jumbo balance certificate for DTCC, one for each issue, registered in the depository's nominee name, Seed & Co. Balances are automatically adjusted each day based on deposit and withdrawal activity at DTCC, and FAST transfer agents electronically confirm balances with DTCC on a daily basis. For exchange-listed equities, agents maintain only an electronic record. FAST was an important step in helping the industry reduce the number of physical certificates being created and moved between DTCC and the transfer agent community. As the physical certificates or securities market consolidated around DTCC as a central depository, benefits to market participants including cost savings, efficiencies, and reduced operational risk. The goal? To reduce physical certificates by processing securities in book entry form on the books and records of the transfer agent. And then lastly, we have dematerialization through DRS. In response to a transfer agent initiative urging the industry to develop an alternative to physical certificates, DTCC's depository, with the SEC support, launched its Direct Registration System, or DRS, in 1996. It's a noun, which allowed individual investors to have their share ownership reflected on the books of an issuer or an issuer's transfer agent. See that? On the books of an issuer, GameStop, or an issuer's transfer agent, ComputerShare. In lieu of physical certificates, investors received a DRS statement of ownership, dramatically reducing cost and risk. In July 2004, the Securities Industry Association issued the Securities Industry Immobilization and Dematerialization Implementation Guide, which reinforced the industry's commitment to full dematerialization and underscored the importance of DRS in attaining that goal. So again, congratulations. You've helped them attain their goal. 2 years later, The SEC rendered DRS eligibility a listing requirement for all new issues starting in 2007, and in 2008 it made DRS listing a requirement for all existing exchange-listed issues. So if it was a requirement this whole time, why would it be a problem if it's required for the DTCC? Because people don't think. Now, with DRS and WT issuers, investors and market participants finally had less costly and less risky alternatives to certificates as a way of recording ownership, promoting further progress on discouraging certificate issuance through the long-standing immobilization and dematerialization efforts. So in lieu of a physical certificate, investors received a DRS statement of ownership. So instead of that physical hard copy of the thing you can see with your own eyes and request at your discretion, you now have an electronic version of it, which is just a statement. So there was also a new deposit option in 2013. DTCC plans, this was written in 2012, but they say in 2013, DTCC had planned to begin offering 3 options to its traditional DAM service, subject to industry and regulatory support. These options will be giving clients alternatives for making deposits, allowing DTCC to reduce centralized deposit processing and realign resources with more critical industry needs. They will be offered for issues in the FAST program and will require the support of FAST agents. So we're only going to look at option 1. If you want to read the rest of this, which I know you don't because you don't read, and I'm only talking to the Reddit people who are in denial. So it is what it is. We're going to talk about DWAC. This option leverages DTCC's deposit and withdrawal at custodian, which is an online facility that allows clients to transmit instructions to fast transfer agents to deposit or withdraw securities into and out of their DTCC account. And by there, it means the fast agent's account. In short, this option removes DTCC from handling the physical certificates and redirects the client's distribution directly to the fast transfer agent, not the issuer. So again, it saves DTCC time and money. The DWAC allows transfer agents to deposit and withdraw securities into and out of their DTCC account, which basically offloads DTCC's risk, removes DTCC from the handling of physical certificates, and redirects the distribution to fast agents, taking all responsibility out of the DTCC. So how on earth would this be a good thing? It's not. You've been helping them. Congratulations. Also, in 2009, DTCC set a 4-year goal to reduce its Seed & Co. vault inventory from 2 million to 1 million. So the argument about taking certificates or shares out of the DTCC, again, if you would read something, you'd realize that was their 4-year goal. And now, 10 years later, it's still their goal. And you're helping them very, very well. So congratulations. And the reason why is due to the collateral problem we have. You think that, of all places, Superstonk would have put 2 and 2 together. But hey, it's okay. By December 2011, DTCC had eliminated 1,095,432 certificates. 2 key developments helped make this possible. DTCC has worked closely with FAST agents to increase participation in the FAST program and further support dematerialization. So, 10 years later, they write this again in 2020. With this paper, DTCC and its depository subsidiary, the DTC, seek the partnership and participation of all industry stakeholders, including banks, broker-dealers. So let's go through this. Banks, Wells Fargo, brokers and dealers, Fidelity, transfer agents, Computershare, issuers. Nope, GameStop didn't participate in this stupid mess at all. Regulators, they did in the past, but not this year. Basically, it's a big, big, big team effort to get you to DRS your shares, which is not possible because it's a noun. They want you to use the DRS. That's how it should be said. You should be saying, hey, we should all use the DRS for our shares. That's the proper English way to say it. The fact that you can't even get the grammar correct shows how dumb you are. Now, together, we will forge a plan to achieve the following goals within the next 3 to 4 years. Eliminate new issuances of securities in physical form. Establish a streamlined process for the conversion of existing physical securities to electronic form. Promote DTCC's FAST program by supporting the conversion of non-FAST agents to FAST in order to transition away from high-touch processing. Incentivize participation in DRS. Oh, you did that, DTCC. You did a very good job. And Reddit was your vehicle to amplify that incentivization. The success of this plan will require strong support from industry organizations. It will also require a full-scale and committed adoption by stakeholders of new business practices, changes in technology platforms, and shifts in the legal landscape. And it will require support from regulators. The benefit of achieving complete dematerialization? Reducing and ultimately eliminating paper. Congratulations, that's all you've been doing, which is what they've wanted for a long, long time. So again, all of you want the market to crash by destroying the DTCC. All you've been doing is creating a more significant and efficient and resilient U.S. marketplace. So congratulations. Full-scale adoption. And again, the only one in this list that didn't participate is DRS, or GameStop. By the way, listing transfer agents on your investor relations page is required by SEC law. Also, disclosing the amount of shares registered with the DTCC and their DRS system on a earnings report is also required by SEC law. Man, it would suck to be wrong all the time. Now, in terms of equity securities, all exchange-listed issues are required to have a fast agent that is also a DTC DRS limited participant who, in conjunction with DTC, provides access to the DRS. So everyone be sure to congratulate Reddit, Trimbrath, Fidelity, ComputerShare, and especially the DTCC for a job well done in accomplishing their goal of share dematerialization. If you haven't noticed, the price has only gone down since you morons have been pushing something you don't understand, and when presented with the facts, you still deny it. How embarrassing.